Abnormal loss incurred by a company during the year. Okay, let me just highlight this portion so that you are clear in your mind as to what is the question that we are dealing with, right? Till now what we saw was, we were given the profit and loss account numbers for the closing balance sheet, and we were given the profit and loss account numbers for the opening balance sheet, and so on, right? The concept of abnormal loss, if I were to explain this to you, lies in the fact that, whenever we prepare our balance sheets, we have to calculate the profits on the date of acquisition. Let's say, for example, this is your date of acquisition. This is 1st April. This is 31/3. Right? Now, the idea is that whatever profits are there up to this date, they have to be ascertained. Why? Because these are capital profits. And whatever profits are there after this date are revenue profits. Right? What happens is that our assumption was that the profits have been evenly accrued during the year. Profits accrue evenly. If you don't understand this concept, you can go back to the previous question, right? There we have explained what is the meaning of this concept, right? You can also go to the website www.iedubook.com, and there you will get this question. But what can happen is that there could be certain cases where you may have abnormal losses or one-time losses, right? Let's say, for example, there was a fire in the business which destroyed some of the stocks, right? And this happened, let's say, on 1st September 2011, right? Let's say my date of acquisition is 1st October 2011, right? Now in this case, if I know that this abnormal loss has happened on 1st September, the assumption that profits accrue evenly will not be correct. This abnormal loss is obviously deducted from the closing profit. Or in other words, the closing profit must have been computed after deducting these abnormal losses, right? So we need to first nullify the impact of this abnormal loss so that we can get actual profit, actually not actual profits, we can get the normal profits, something which the business would have earned normally if this abnormal loss would not have happened, right? And then adjust this in the period in which it should actually happen. So if it happened on 1st September, it basically is a loss of capital nature. Why? Because it is happening prior to this date and should be adjusted from these profits. Or if it happens, let's say, on 1st of December, then it is a capital adjustment. This is a post-acquisition adjustment, right? Adjusting it evenly over the period of 12 months will be incorrect, which happens if we just consider the balance given. And that is the requirement, that is the place why requirement of this thing comes into picture, right? Now let's see. So you are given the balance sheet of the two companies. It's the standard balance sheet which we've seen in many examples, so I'm not going through it once again. Let's see what is the notes say. The acquisition of shares took place on January 1, 2012. So if this is my timeline, 31/3, on January 1, the acquisition happened. Which means what? Which means that during the year, 9 months were pre-acquisition period and 3 months was post-acquisition period. Now, whenever you get something like this, that the acquisition happened during the year, one thing you should clearly note in your mind is that there is a time adjustment which I have to do in the analysis of profit segment, right? However, it was informed that there was an abnormal loss in August 30, 2011 for rupees 10,000, for which nothing could be recovered from the insurance company. Now what this says is that on August 30th, where will August 30th lie? It obviously lies before January 1. So on August 30th, 2011, there was an abnormal loss of 10,000 which happened, right? For which nothing could be recovered from the insurance company. Now clearly, if this August 30 is the date when this loss has been incurred, you cannot adjust this simply over the entire period. Balance in profit and loss account of S Limited on 1/4/2011 was 30,000. So the balance here is 30,000. What is the closing balance? Closing balance of S Limited is 80,000. Now obviously this closing balance has been arrived at after reducing this abnormal loss, right? So to give the correct impact of this, we need to make an adjustment in our AOP, right? Which we will see in the AOP segment. But before that, let's just quickly draw up the balance sheet and other stuff. Fixed asset 170 plus 110, 280. Fixed assets 280. This time I've just put in this structure in place before so that we don't need to run around every time and spend some time out here. Just to save time maybe. Investments 1,50,000. So this time my cost of control, my investment amount is 1,50,000. Current assets 180 plus 160, 340. Current assets 3,40,000. There's no bifurcation out here, right? And again, this fixed asset, what I mean is the tangible assets. Creditors 290, 290. Equity share capital 2 lakh, profit and loss account 1 lakh. Equity share capital 2 lakh, profit and loss account forms part of this, 1 lakh is the balance, and we'll see how we move forward in the rest of the things. Equity share capital of S is 1 lakh. Okay, how much do we own? 70%. So in cost of control less equity share capital 70,000. The balance 30% belongs to the minority equity share capital. So I have bifurcated this equity share capital as 30,000 in the minority section. The beauty of the thing is that if you just pick one balance, put it in the right column one by one, then the chances that your closing balance sheet will not tally are minimal. Profit and loss account 80,000 is the closing balance. Come to AOP. AOP acquisition date 1/1/2012. Total. What is the total balance of profit and loss account? 80,000. Profit and loss account. Capital. Revenue. Right? How much is the capital balance of the profit and loss account? We know that is 30,000. It's given. 1/4/2011, the balance is 30,000. Right? For those of you who do not have these questions, you can go to iadubook.com. Okay, below every video, the question is available. Right? So as a notes to the videos, we have posted these relevant questions as well. Or these may be available in the subject notes section of iadubook.com. Less equity share capital 70/30 I have split it. Reserves and surplus 80 I have gone, 30 is there. Right? Now comes the question, how much are the revenue ones? 50,000. This is subject to time adjustment, right? Subject to time adjustment, it is 50,000, right? The thing is that before I allocate this between pre and post, just look at this particular sheet out here. I know the acquisition happened on January 1, so I need to know the profits earned during these 9 months, right? And 3 months separately. But what I can't do is I can't just straight away reduce from 80, 30. This 80 has been arrived after considering this abnormal loss of 10,000, which I know clearly is a pre-acquisition event, right? So first what I will do is I will add the abnormal loss of 10,000 over here. This gives me 60,000, 30,000. So 60,000 would have been the normal profit if I would not have incurred that abnormal loss, right? So the thing you have to do whenever you have abnormal losses, first compute the normal profits. Capital is this much, obviously there is no adjustment, revenue is this much. Then I allocate this between pre and post. How much is the pre period? Pre period is up to January 1, 2012, 9 months, and this is 3 months. So I straight away, out of the 60,000, I multiply it by 9 divided by 12 and I subtract this number from here. This is 45,000. And I add 45,000 to the pre-acquisition profit. 75,000 and this is 15,000. 60 minus 45. Right? Now, in any case, I have incurred this abnormal loss. So it has to be reduced because my actual profits are not 75 plus 15. My actual profits are not 90,000. My total profits are 80,000. And how do I reach there? By reducing this abnormal loss from the relevant period. Minus abnormal loss. And which is the period? I incurred this loss on August 30, which is prior to the date of acquisition. So I will reduce the abnormal loss from here. 10,000, 65,000, 15,000. Out of this, holding owns how much? Let me use a different color. 70%. Minority, 30%. So this will be 45,500. 19,500. Similarly, this will be 10,500 and 4,500. So the share of minority, I'll put in the minority interest, 19,500 plus this will give you share of profit, 24,000, 54,000. Then for holding company, this is 45,500 and 10,500. So 10,500 is the revenue profit. So I added to my reserves and surplus as a part of consolidated profit and loss account plus revenue profits 10,500, and the capital profits are going to be reduced from my cost of control 45,500. Sum of these two 115,500 when reduced from 150 will give you 34,500. This is goodwill. Why? Because I paid more, I got less. So what I have paid surplus is goodwill. Non-tangible goodwill 34,500. Minority interest, how much is the number? 54,000. Sum of these two 110,500 I can put in here. Right? So what's the total? 654,500. Can you please check it for me? 280, 620, 654, 500, 200, 4, 6, 610, 654, 500. Correct. So what did we learn in this question? We learned that whenever there is an abnormal loss, our closing profits are reduced by this abnormal loss, right? But because this abnormal loss is a one-off item, we try to find out what is the date when it was incurred. So we first increase our closing profit by abnormal loss to get down to the increase our closing profits or profit earned during the year by the abnormal loss to get the normal profits. Once I have the normal profits, I do a time adjustment. Once I've done the time adjustment, I get the regular profits. Then I reduce the abnormal loss from the period in which it was incurred. This can be pre or post. In our example, it was pre. I reduced it, allocated it between holding and subsidiary and got the answer.